Hey guys, this is Alan Moore, certified financial planner and founder of Serenity Financial Consulting. Thanks for joining me. It seems like every investment book that you read has the tip to buy low and sell high. It's, pretty much everywhere, every white paper, every list of tips that you can find on investing. But what does this actually mean? I mean, it's great in theory. You buy something for cheaper and you sell for more expensive, right? It's just like going out and buying a used car for cheap and then going down the road and selling it for a higher price. Of course, it makes sense. But how do you actually do this when it comes to the stock market? I'm going to give you a strategy that research has suggested works very effectively at buying low and selling high. But first, I want to discuss a couple of the difficulties with this concept. The first thing is, do you know which stocks are going to go up? So if you know that you need to buy low, you need to know whether or not a stock is low so you know whether or not it's going to go up so that you can buy it. The problem is, if you know a stock's going to go up, does anybody else know? Because if other people know, they're probably already buying it, and which is going to drive the price up, and your knowledge is going to be ineffective, right? Research has shown that no one knows if stocks are going to go up tomorrow or not. So one of the difficulties is if you are trying to buy low and sell high by stock picking, it's not going to work, okay? The second difficulty is the psychology of buying low and selling high. Effectively, what you're saying is you have to sell your winners. You have to go in and say, this stock has done really well for me, and now I'm going to sell it. Again, in theory, it works because you've locked in your gains, and now you're going to take some money off the table. But in reality, when you go to sell that stock, it is difficult. It hurts. Our brain, actually, the way that we're wired, it actually hurts us to sell a winner like that. And why would you? It's done so well. We humans tend to experience something called a recency effect, where we don't really think about the last 3 years, we think about the last 3 months. And so if it's doing really well, we look at it and go, oh, but it's going to continue to do well, right? The other problem is the buying low part. So think about this. You've got to actually buy a loser. You've had a stock that's gone down for the last couple of months, and now you've got to buy more of it because we said you were going to buy low. So you got to sell some of your winner and buy some of your loser. Why would you do that? Now, again, in theory, this buy low, sell high makes sense, but in reality, it's very difficult to actually execute because our emotions get in the way. So I know what you're thinking. So you're telling me there's no way to buy low and sell high. That is not what I'm saying. I just wanted to cover a couple of the difficulties with the concept. The way you overcome these difficulties is by automating or at least systematizing the process, and this is called rebalancing. So basically what we do is, let's say that you've decided you want 50% of your money in stocks and 50% of your money in bonds. Let's say over time, stocks go up, bonds don't do so well, so now you have 60% of your money in stocks and 40% in bonds. What we want to do is sell some of those stocks, buy some more bonds to bring it back to the 50-50 that we originally wanted. This does mean selling your winning stocks and buying those losing bonds, but this is where the psychology kicks in, right? Because you're thinking, oh my gosh, the stocks have done so well, or why would I buy those bonds? They're doing pitiful, interest rates are low, it doesn't make any sense. That's why you've got to automate it. You've got to be systematic about it. So what you need to do is pick a date, such as your birthday, and at least annually, but no more than quarterly, sit down and rebalance no matter what. Sell your winners, buy some of your losers, bring them back into balance with what you originally wanted. This is the only way that I know of to take the emotion out of it, is just to pick a date and do it and just gut check it and get it over with. But it is difficult to do. So what do you think? Have you ever tried rebalancing? Have you ever actually sold winners and bought losers? Did it hurt? Was it easy? Definitely feel free to share in the comment section below. Before I jump off today, I do want to tell you, just for full disclosure, the way that we do this with clients, because it is a little bit different than what I'm suggesting that you do. We actually check weekly whether or not clients' portfolios are in balance. And if they are more than 20% off, then we rebalance. So basically, if we're targeting 10% in U.S. stocks, if it gets above 12%, we'll sell some of those U.S. stocks. If it gets below 8%, we'll buy more of those stocks. So this is actually a weekly check, but only rebalancing if you're more than what we call 20 out of 20% tolerance bands. So I just wanted to be, give full disclosure that we do it a little bit differently than the strategy that I'm suggesting that you do, of just sitting down and doing it quarterly or annually. But, effectively it ends up with being the same thing. That's all I have for today. Thanks so much for joining me.